Welcome back to the Deep Dive. Today we are strapping in for a really essential look at what I'd call the engine room of the global mobility transition.
TATA Technologies, or TTL.
Exactly. This deep dive is customized for you, and we're focusing on this really complex intersection of their Q2 FY26 results, their huge cash-intensive strategic moves, and, well, the pretty cautious reaction from the stock market.
It's a fascinating company, and it operates in such a high-growth niche. TTL is, what we call a pure-play engineering, research and development, and digital solutions specialist.
And their focus is just laser sharp, isn't it?
Oh, you can't overstate it. 81% of their revenue is all in the automotive sector. Our sources note they're ranked among the top 2 global engineering service providers in electrification.
Top 2.
Yeah, and they're number 1 among India-based global automotive ESPs for the 8th year in a row, I think, according to Zinnov Zones. So they're a real heavyweight in an industry that's completely transforming.
So our mission today is to really unpack that hard data and the company's aggressive strategy to pivot toward the software-defined vehicle, or SDV, future.
Right.
But we have to tackle the core conflict right out of the gate. Management is reporting strong progress and a clear return to growth in Q2. But then you look at the trading signals, and the technical analysis is just screaming caution.
It is. It's still defined by a downtrend dominant phase. It's the classic confrontation, the long-term optimistic vision from the boardroom versus the skeptical immediate reality being traded on the floor.
So the question for us today is identifying which set of signals, the fundamentals or the technicals, is going to dictate TTL's value over the next year or so.
Let's find out.
Okay, let's start with that Q2 FY26 financial snapshot. Management really wants to call this a success. And to be fair, there is some real resilience here. Let's dive into the headline numbers.
Okay, top line first. Total company operating revenue hit 13,233 million rupees.
Which comes out to about 150 million US dollars.
Exactly. And that was a 6.4% jump quarter on quarter. Critically, even when you adjust for currency, the revenue is still up 4.5% in constant currency. That is a return to growth.
After a period of being pretty flat, right?
Yeah, exactly.
And their core business, the services segment, that's still the lion's share, 77% of revenue.
And that's the high margin segment. Services revenue itself was 10,128 million rupees, which is up 5.1%, or about 3% in constant currency.
Okay.
So growth is back. But you have to ask yourself, considering the massive industry tailwinds, this huge global shift to electric and software, is 4.5% growth actually meeting the high expectations for a premium player here?
That's a great point. It feels good, but maybe not great, when the whole industry is spending billions on R&D. What about profitability? Net income was 1,655 million rupees.
Which gives you a 12.5% net income margin. The margin discipline is solid. They hit an adjusted operating EBITDA margin of 16.4%.
And that's adjusted for something, right?
Right. Management made it clear that excludes a small one-off consulting fee from a cyber incident. So their performance remains stable, even with all the macroeconomic hurdles. They're just very efficient operators.
Okay. Now, here's where we need to put on our critical hats. Because the fine print, it reveals some pretty significant risks. And I think these are the risks the market is reacting to.
The primary concern is all about liquidity. It's their days sales outstanding, or DSO.
That's how long it takes them to get paid by their clients.
Exactly, and it jumped. It jumped aggressively from 87 days in Q1 to a whopping 109 days in Q2.
109, that's a 22-day deterioration.
It's huge, a huge slowdown in collection efficiency.
At 22 days is massive. We have to connect the dots here, right? TTL is chasing this huge cash-intensive acquisition we're about to talk about. And they're doing that while their ability to collect cash is slowing down this dramatically. That signals some serious pressure on the balance sheet.
It absolutely does. A DSO spike like that usually means one of two things. Either TTL is offering really aggressive payment terms to win new deals, basically financing the client,
right?
Or they're just facing a worrying slowdown in getting paid globally. Either way, it just eats up working capital right when they need cash the most.
And there's another flag, the talent metric.
Yep. Voluntary attrition, so people leaving on their own, is sitting at 15.1%. In a services company where your talent is the asset, that level of churn is a real risk to getting projects done well.
And then the outlook they gave was Well, it was a mixed signal at best. It was basically enjoy this growth because Q3 is going to be rough.
That's right. Management was transparent. They flagged short-term tactical challenges and near-term demand softness for Q3. All the confidence is resting on a promised solid rebound in Q4.
So the whole investment thesis kind of hinges on them weathering this immediate storm and pulling off these big strategic shifts.
That's the whole game right now.
Okay, that sets the stage perfectly for our second segment. Because the only way you can justify a premium valuation with all those financial pressures is through the strategic moves they're making. And they are not waiting around. They are investing heavily.
This is where they put their cash, where their strategy is.
Yeah.
The single biggest move in Q2 was all about expanding in Europe, geographically and in terms of their capabilities.
And Europe is really the epicenter of premium auto engineering.
It is. So tell us about the acquisition.
TTL signed a definitive agreement to acquire 100% of ES Tech Group in Germany. The price tag is up to 75 million euros in cash.
Wow. 75 million cash?
Yeah. And this isn't just about buying revenue. This is a strategic play to scale their ER&D operations right in one of the most advanced auto innovation hubs on the planet.
The value there is twofold, I guess. You get immediate access to top-tier talent, and you get this deep, specialized expertise that would take years and years to build on your own.
And that cash outlay, 75 million euros, that looked particularly sharp when you view it against the 109-day DSO, doesn't it?
It really does. They are spending big at a time when their cash pipeline is slowing down.
So they must believe the strategic need just outweighs that immediate risk.
Precisely. And they need this acquisition to lock in these high-value future programs. In fact, right after this move, they secured their first direct deal with a leading German OEM for body engineering services on all future vehicles.
All future vehicles. That is massive.
Yeah.
It's more than just a win. It's a huge commitment.
Oh, yeah. You don't just walk into a premium German automaker and ask for the keys to their entire future. That's a relationship built on decades of trust. It shows they're really making headway in that market.
But the real structural transformation is happening in the digital space, right? The focus on the software-defined vehicle.
Entirely. Everything in a modern car, from navigation to braking, is increasingly defined by software. And TTL is pivoting their whole value proposition right there.
So how are they making that leap from, physical engineering to this high-margin software work?
Through critical partnerships, they have a new strategic collaboration with Synopsys.
A leader in electronic design automation.
A huge leader. And this partnership is all about virtual validation. So instead of waiting for physical parts to be ready, they can simulate all the complex electronics and software interactions way early in the design cycle.
Which fundamentally shifts them from being a physical engineering partner to being more of an architectural and integration partner.
And that is significantly higher margin work.
And they've already road tested this capability.
They have. They showed big value at a pilot with a major European luxury OEM. Plus, TTL is developing their own proprietary IP to get ahead of new global regulations. That brings us to WattSync.
WattSync. Okay, that sounds technical, but the core idea is it solves a massive global compliance headache, right?
Absolutely. WattSync is a digital battery passport platform. In simple terms, it uses blockchain and AI to track the entire life of an EV battery.
From mining the raw materials all the way to recycling.
All the way. And this is crucial because it helps manufacturers comply with the demanding new EU battery regulations, which require total visibility. TTL is positioning itself as a key solution provider for global sustainability compliance.
That's incredibly forward-looking. But to execute on all of this ES Tech, Synopsys, WattSync, you need world-class talent, which brings us back to their focus in India.
Right. Management acknowledges that India's potential is being held back by a big skills gap, so they're taking steps. They partnered with Intel India to accelerate AI skill development on their IT platform.
Okay.
And they're also setting up 2 new innovation and training centers for the government of Maharashtra. This isn't charity. It's an essential strategic investment to make sure they have the pipeline of engineers they need.
So on one hand, you have this clear multi-front strategic offensive. Cash acquisition, proprietary IP, high-value partnerships. On the other hand, the market is just not buying the growth story yet.
Not at all.
Let's transition to segment 3 and look at that market perspective. The deep caution and this consolidation phase.
The disconnect is striking. Despite all the operational strength we just discussed, the stock performance is, it's bearish. As of November 2025, the stock is trading around 675 rupees.
Down dramatically from its peak, 35–40%?
Yeah. It's been in a clear long-term downtrend, lower highs, lower lows, and now it's just stuck in this tight sideways consolidation phase between 670 and 693.
And let's talk about those technical levels. For traders, these aren't just numbers, they're psychological lines in the sand.
They are. The price is consistently trading below the 200-day simple moving average, which is around 737.
And being below the 200-day is the market's long-term health barometer.
It is. When you're below 737, it means pretty much every investor who bought the stock in the last year is currently underwater. That is a huge psychological hurdle to clear for any kind of reversal.
So you have the immediate support at 670, which gets tested a lot, and then resistance at the 50-day SMA around 693.
The stock is essentially coiled. But the coil isn't showing any positive energy yet. The RSI is sitting at 41, which is neutral leaning bearish. And what's more telling is the volume.
Okay.
You see spikes in volume, mainly during sell-offs, but you see a real lack of strong, sustained buying volume. No clear signs of institutional accumulation that would signal a trend change. The technicals are unambiguous, downtrend is dominant, and we're just waiting for bullish confirmation.
So why are experienced brokerages who see the underlying growth, who see the smart strategy, still maintaining sell or reduce calls? Why do they think the stock is still too rich?
It really boils down to multiple compression and external risks. First, brokerages like ICICI Securities cite the rich valuation multiples compared to its peers. They argue that while TTL is a premium company, the premium is just too high right now given the headwinds.
And you can't ignore the broader environment.
Absolutely not. They face external cyclicality, global macro challenges, specific EV program delays. Manufacturers are getting more cautious with their capital. And then there's the group-level overhang.
Right, the broader TATA group.
Yeah, it experienced a lot of sentiment pressure in 2025 because of governance disputes and just general pressure on flagship stocks like Tata Motors and TCS. And that naturally casts a shadow of caution over TTL.
So for investors or traders looking to get back in, what's the ultimate confirmation signal they should be waiting for?
The outlook is clear. Wait for the stock to prove it can sustain a move above that immediate resistance at 693. But the real long-term bullish confirmation only comes with the sustained move above that psychological line in the sand.
The 200-day moving average.
Yeah.
At 737.
That's the one. Until then, the market believes the risks just outweigh the opportunity.
So let's synthesize our core takeaway for you today. Tata Technologies, they achieved a critical return to growth in Q2. They are making massive, non-negotiable investments.
Spending up to 75 million euros in cash on ES Tech, launching proprietary software like WattSync, partnering with Synopsys. These are ambitious, complex, and very costly pivots.
The immediate challenge is twofold then. Navigating the expected demand softness and collection issues in Q3, and then overcoming these significant technical resistance levels to regain investor confidence.
Right. The market is waiting for indisputable evidence. Evidence that executing on these complex integrations will finally translate into sustained earnings acceleration, especially while all these broader concerns persist.
The company is transforming. From a traditional engineering partner to a digital and SDV specialist, backed by this massive cash acquisition and new software aimed at solving global compliance problems. So given the dominant growing role that software plays in mobility, the question for you to mull over is this. Will the execution and successful integration of these complex, high-value strategic pivots finally outweigh the current short-term technical and macroeconomic headwinds?
We'll leave that hanging for you to explore as you watch the Q3 numbers roll in.
Until the next deep dive, we'll catch you later.